So as you can see here, we've got listed 11 states that do not tax retirement income in some form or fashion. We're currently located and broadcasting to you from the state of New Jersey, which you do not see on this list. We'll shortly focus on a few states that we've seen, retirees retire to or flee to, and I'll share some considerations there. When we're referring to retirement income versus just income in general, as I mentioned, 8 of these states do not tax any form of income, Florida being one of them. So of course they wouldn't tax retirement income. Now, retirement income is pension income from a corporate or local state municipality. You've got IRA distributions, 401k distributions if the money remains in the 401k, and Social Security. Like I shared earlier, a majority of states do not tax Social Security, but few do. And right now we'll focus on some of the states that are a little bit more tax friendly, and then just some considerations with some of the other states.
Perfect.
If you can continue to the next slide. So states that don't tax retirement income, the two that I'm going to focus on here are Pennsylvania and Florida. Two kind of different scenarios. With Pennsylvania, they do tax earned income. However, retirement income is a different story. In order to qualify for your retirement income to be tax-free, you need to be retired. You need to be a Pennsylvania state resident and over the age of 60. Florida, again, they do not tax any form of earned income or retirement income. So, I think just about every state has seen folks, retire to Florida, and it's not always because of the tax benefits. I think some just like the warmer weather, which I can't blame them there. An example I've got listed here below compares Pennsylvania with North Carolina, and the reason I use North Carolina, again, North Carolina in recent years has somewhat become the new, I'd say Florida. South destination for the new Florida, if you will, but not always is it a tax-friendly decision. So they have no retirement income exclusion, and I'll talk to you a minute about what I mean there. So some retirement income exclusion, some states will have a certain threshold where the first $10,000 is tax-free, and then anything beyond that is taxed at a flat rate. But North Carolina, they're going to tax 5.25% on all earned income or all retirement income, excluding Social Security. So in this example, you see the difference between whether you're a resident in Pennsylvania or North Carolina. Two identical situations, you're looking at about a $4,500 tax savings.
Beautiful. Excellent example. And there's tools to help with that, and we can do that as well if you're contemplating a move and want to see the impact to taxes.
Yeah. When I refer to states that do provide certain exemptions on retirement income, I focused here, again, if we went through state by state, we would be here all day, but I focus on a few states that are sort of in our surrounding neck of the woods. New York, for instance, they're gonna provide the first 20,000 based on certain criteria to be exempt. Now, if you are a New York resident and have a New York state pension, well, that pension will be tax-free. So all of the income from that pension will be tax-free. But in order for that to be the case, you need to reside in New York. So as soon as you move outside of New York, then it becomes taxable. Delaware, a lot of people focus on Delaware for being a very tax-friendly state. Well, not so much when it comes to retirement income. The first $2,000 is excluded for individuals that are under the age of 60. After that, you're looking at the first $12,500 to be excluded, and that doesn't include Social Security. All of the states that I've listed here all provide Social Security to be tax-free at the state level. Georgia, a little bit higher of an exclusion amount, $65,000, and then New Jersey, I'll talk about here in a minute. A lot of people, focus on New Jersey as being very or not very tax-friendly, especially when it comes to income in general or retirement income. They've implemented some things over the past couple of years that's eased that up a little bit. And if you can go to the next slide. So this came to play, I believe it was 2017, and they slowly have phased in this exclusion amount. However, the first couple of years, there wasn't a whole lot of individuals that would qualify because the exclusion amount was fairly low. It sort of hit the precipice in 2021, 2020, for a married couple with income under $100,000. And when I say income, I mean New Jersey state income. So you can exclude Social Security from the equation. You can exclude tax-free income. It's New Jersey taxable income under 100,000. Then all of their retirement income would be tax-free. So think of an individual with, they're collecting Social Security, but that's out of the equation. Both are retired, no earned income from employment, and their IRA distributions keep them under 100,000. Well, all of those IRA distributions will be tax-free at the state level.
Wow.
They'll pay federal tax, and this is important because when you set up an IRA distribution, like Rory and Shane mentioned earlier, you're going to want to set up a tax withholding. But if you're withholding at the state level, you're distributing more money, hence increasing your taxable income, and it becomes a double-edged sword where that's something that analyzing or projecting where you're going to fall from an income standpoint becomes very important in this case. In order to qualify, you or your domestic partner, spouse, need to be 62 or older, so at least one of you. You need to reside in the state. And in 2021, they took that income threshold from 100,000 up to 150,000, but there's certain caveats to that. Prior to this increase, when you went one penny over 100,000, then all of your retirement income was taxed. So this is a little bit different than Delaware and Georgia and South Carolina, where they excluded the first, the first 30,000 or the first 12,500 or the first 65,000. In New Jersey, once you go one penny over 100,000, then all of that retirement income would be taxed. Again, very important to kind of analyze. If you can jump to the next slide, I'll show you kind of where we've gone from there. So married couple filing joint under 100,000, then all of the retirement income is tax-free. If you're single, that income threshold 75,000. So in this case, you see in normal circumstances, or I'd say more often than not, it's like a 1-to-1 ratio, where a single individual would have a threshold of 50,000, married couple would have an income threshold of 100. In this case, it might behoove a couple to file single versus married filing joint. Now below you can see where we've kind of where the adjustments that have been made since 2020, and individuals that go over 100,000, and I'm going to focus on the married filing joint. If you go over 100,000 but are below 125,000, then 50% of the retirement income will be taxed. The other 50% will not. And you see those other income thresholds below. Once you go over 125 but are below 150, that number is reduced to 25% will be excluded or tax-free. 75% will be taxed. Once you go one penny over 150,000, all of the income is taxed. And New Jersey's, state income tax, it's not a set percent. It's somewhat of a sliding scale based on how much income you make, but it can range anywhere from 6% all the way up to a little bit north of 10%.
Sure. Great. Well, a lot there. Really appreciate that. Very thorough. And with us being in New Jersey and having a large number of New Jersey residents, I think it's important to know where you stand and the impact of maybe having an income event pushing you over that one penny and theoretically making a good portion of your income taxable in the state of New Jersey. So Hopefully you have a few takeaways from this discussion today on the state level, but then also on the federal level. And we have a little over a month and a half to make any potential changes to either increase income through Roth conversions if beneficial later down the road, or exercising options, things of that nature, or some things that you can take advantage of to reduce income or maximize benefits, like maxing your 401k plan. If you are planning on utilizing the mega backdoor Roth strategy, that's a big number, $61,000. Are you on pace for that? If you're not on pace for it, can you increase contributions and fully take advantage of that? So there's a number of things to think about from a planning perspective. I think it all starts with getting a rough estimate to what your current income is, what your projected income is going to be, and then where are the planning opportunities that you can take advantage of to benefit your situation and that of your families. Again, we're here to talk through this on an individual perspective, so feel free to reach out to us. Again, connect with us and follow us on our YouTube channel, and appreciate everyone that tuned in here live today. Shane, Geoff, thanks again for doing this, and all of us at Ausperity. We hope you have a great Thanksgiving with your families. Thanks for tuning in, and we'll be in contact soon. Thanks.
Thank you.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.